Now here we're going to turn to the U.S. And as we said in the last segment, even though the Fed continues to tighten, QT or whatever they're calling quantitative tightening, because it's really not happening at a level that you would expect given what they're trying to achieve. And a lot of that is because there's a significant amount of liquidity still in the RRP. There's still a lot of progress to be made, but we have to look at inflation and the bite that inflation takes on who. And the Wall Street Journal had these great pieces in this great article. And these were two charts that stuck out, is how inflation hits middle income households the hardest. And the consumer price index by income decile changed from May 2020 to May 2022 based on prices for goods and services weighted for consumption patterns of households at various income levels. And I think that's really important because everybody's going to spend differently. And you get an idea of just how elevated that is. And again, they stopped at May 2022. We know that there was some adjustment lower in the inflation levels. So this is also, you have to be, when you're looking at data like this, just to appreciate that it's just a point in time. And things have gotten a little bit better on some areas, but if you've been to the food store, it hasn't gotten much better. If you still are going out to eat, if you're still going to get takeout, it's actually gotten much worse in that time period between May 2022 and today. So there's that mixture, but it gives you a sense that even though the total numbers never got past that that meaningfully 9%, we were always kind of stuck at this level. You can see that there was still more pressure at different levels. And then the share of U.S. households saying it was somewhat or very difficult to pay bills by income level. It's not surprising that the less you make, the harder it is to pay bills. But the important one is that light blue line, the 35 to 99 or 100,000. You're seeing the rate of change increase exponentially between the 35,000 and just below the 200,000. That's a problem because those are people that, especially as you get closer to the bottom, those are people that have the most discretionary income. Those are the ones that are going to spend the most, go on vacation, go travel. And that's where we're seeing the biggest pressure point. And that's why and we've shown charts on here before, the issues when you go back through from the 1970s onward, that as inflation went up, there was a bigger and bigger impact on the middle class and how wages were working and how they were not really addressing and moving with the inflationary pressure. And that's why when you look at the demise of the middle class, we have to look at monetary policy and how much of that was caused by this inherent expense that is hitting people very hard. Which is why when you get these inflationary pressures coming out, you've had employment, because remember, the Fed has a dual mandate. They have inflation and employment is still gangbusters. We're going to talk about it in the next segment, a little bit in this segment. But then the employment data is very strong. Even if you adjust for seasonality and take into account it's January, those were good numbers. That's not going to stop the Fed's movements. That's going to make them want to move faster and stay longer. So the Fed funds future curve continues to move up. Here's when we go from January 2nd to February 7th. You've gotten that big shift up. But there's still this certainty in the market that the Fed is going to reduce rates in the back half of the year. And we just don't see that. And now you're starting to see actually even a little bit more panic. Now this chart is looking at the implied Fed funds rate at the June meeting. It's actually gone up. So, when you look at this and when you look at June, there's an assumption that June is kind of in that August period is the peak, and then you start getting rate cuts. We think that the Fed doesn't go as high as they should. They don't go to 5.5% to 6% as some of the most recent data, and we'll show this in Friday's show is showing. But there's still a reason to be at between that 5 and 5.25%, which we think is very likely. Now, market has rapidly adjusted its expectations for the Fed funds rate. With what the Fed is expecting in terms of terminal rate, market's expectations for cut is a different story. where the Fed continues to say they're not going to cut this year, but the market obviously disagrees. And then the market's expectations for Fed funds rates by June, FOMC meeting has jumped back up, now near the peak reached in November 2022. And here's a key component where the U.S. 2 to 10 year curve inversion reaches new multi-year extremes, and it's the lowest, it's the most extreme it's been since the early 1980s. And typically when you get these inversions to such a degree, you have to look at just what happens following that. And that's why we think, obviously, that we've never gotten to this point and not had a recession. And that's why when we look at some of these concerns and how in the market there's this certainty or expectation that we're going to have a soft landing, that we're going to be able to avoid a recession, this gives pause. And when you think about the Fed raising rates, given where inflation is, how it's going to be sticky, and we're going to talk about service costs, how that's gone back up, it's going to become a much bigger problem, which is why the CEOs, when you look at the conference board, CEO worries, number one concern for CEOs around the world is the economic downturn and recession. Inflation comes in on a fairly close second. And that's going to be the biggest driver, where if you think there's going to be an economic downturn or at least a slowdown and inflation's going to be there, that's going to change CapEx schedules. That's going to change hiring schedules. That's going to adjust the way people take action in the market. And that's going to be an important one to watch. U.S. trade gap widened to a record in 2022. And it's just when you look at some of the shifts in general, a lot of this was on imports, where imports went up and exports stayed fairly flat, moving up. But again, imports outpaced exports. And this leads back to some of the concerns that we've been highlighting when it comes to importing some of that inflationary pressures as they continue to remain in the global market. So now when you look at the Treasury yields, banks' willingness to make consumer loans have fallen sharply. Net percent willing to do so has fallen into negative territory. So banks are looking to make loans, even though some of the, again, and it depends on who we're using. So Goldman Sachs has seen some of the financial pieces easing. This is showing a little bit more tightness. And then when you look at real rates, inflation expectations, and Treasury yields, you can see that when you look at the real rates, even though we have rates that have gone up, real rates are still negative. And that's why when there's this move or this belief that there's going to be this panic cut, we still have negative rates. So we haven't even gotten to a positive yield on a real rate basis, but yet we're already talking about cutting rates. And that's where they have to try to bring people back within their fold and look and try to tighten some of these things and see some of this liquidity come out of the market, as we saw with this willingness to make consumer loans. And when another key piece is the 6-month annualized change in revolving credit has eased, but from its peak, but it's still moving at about 13%. So you still see revolving credit being used. You still see the consumer relying on additional credit. Lending standards tightened further in January per the latest Fed data. So 44.8% of domestic respondents tightened conditions in January, pace and level both consistent with prior recessions. So you're still seeing some tightness. But people are relying more on credit. We have a record amount of credit card debt on hand. We're up to about just over $930 billion. The interest rates continue to move up. It's currently sitting at just over 19.9%. But as percentage to consumption and spending, it's still manageable, but moving in the wrong direction. And that's, I think, the biggest concern when you start looking at it and what the definition is in terms of where they are in regards to the amount available is based on savings. And as we've been saying, we think the savings number is grossly overstated, so that the level of credit and the level of financial leverage is actually a bit higher on the average consumer, especially given how they're being hit with inflation at this pivotal, let's call it 40,000 to 200,000. That whole piece that which is a very wide amount and covers a significant amount of Americans is a huge issue when you look at spending and the way they're moving. So, and how is that impacting? Well, almost 2/3 of U.S. consumers living paycheck to paycheck. So when you have that many people living paycheck to paycheck, any movement in credit, any movement in interest rates, any movement in inflationary costs is going to be detrimental because people are already not putting enough into savings. They're already trying to live paycheck to paycheck. And as inflation outpaces paychecks and wage increases, that only increases the strength, which is why it's no surprise to see Americans, in the most recent Gallup poll, Americans' financial situations now versus a year ago. And we have 50% saying they are worse off, with only 35% saying better off. And this is the worst number it has been since 2009, to give you an idea of where the consumer believes they're sitting. The U.S. is set to continue to run twin deficits, totaling around 8% of GDP. And the problem with that is, as rates go up, and again, we not only issue new debt, but roll old debt, our interest expense goes up, and that increases the cost, and then increases the deficit, and then increases. So it has a compounding effect and just continuously gets worse, which is why this is a reason that others are saying the Fed can't raise rates, because if they raise rates too much, then the government can't fund itself, which is accurate. But they're supposed to be different. I know we can argue if they are. They're supposed to be different, and the Fed is supposed to be looking at long-term growth. And the Fed has come out and blatantly said, and finally, that what the government is doing is unsustainable, and they have to rein it in and bring things back into the fold, because we can't keep outspending, because it's just the cost is too much. And the only way to really snap people out of that is monetary pain. We need higher interest rates to get people back into that level. Current headline CPI versus some of the expectations. So when you look at that dotted line, you can see that, the expectation is that it comes back down. But then this line here looks at the 1970s, and this is what the Fed keeps looking at, and this is what we keep trying to talk about. There is a fear of a double dip, because this spike back up, that created a wage spiral. That created the need for Volcker to go and bring rates over 20%. They want to avoid that. And the easiest way to do it is keep rates higher for longer, because that was an error that they did, where they raised rates through 1976 into 1977 and then aggressively cut. And that created that next bellwether in 1978. And they were very slow to raise rates, creating those issues that we're looking to avoid. And the reason why is, falling real wages hurt consumption. Consumer spending versus real labor income is a problem when you look at the disconnect. So when you look at that disconnect, the options are allow for a wage spiral, allow for wages to continue to rise. And wage spirals, once they're out there and they start, the reason why it's called a spiral is they spiral out of control. It's easier to bring down asset prices, or I should say, more structurally safe, or cyclically safe, to bring down asset prices instead of pushing up wage prices, in order to create some stability in the underlying market. Which is why when you look at U.S. private construction spending, residential is still massive. We're going back to 2007. There's still a huge amount of asset spending. And these are places that we think things can continue to come down. So then when you look at U.S. average hourly earnings, increased 4.4% year on year in January, the slowest growth rate since August of 2021. This is the 22nd consecutive month where inflation outpaced the growth in wages, a decline in prosperity for the American worker. So again, that's more pressure on where we continue to see things. So even though CPI has come down, wages have come down faster. So there's still pain, which is why when you look at the amount of people already spending, the amount of people living paycheck to paycheck, this becomes a much bigger overhang on spending. Now, this is looking at financial conditions based on Goldman Sachs. They've eased considerably over the past 90 days, now at the fastest rate since September of 2020. And then here, when you look at U.S. banking lending standards and demand, banking standards have kind of flatlined, but the demand hasn't been there. And that's why you're seeing conditions. One of the reasons why, again, depending on the metric we use, so Goldman Sachs is saying that financial conditions are getting easier. And it's not so much, and the reason why that could be the case is because you just don't have the demand. So as demand isn't there, financial companies need to move money. They have to write debt. They have to try to move this. You have to incentivize, and how do you get people to do it? You make it a bit cheaper. You shrink your margin or your spread between the risk-free rate and what the rate is in the market, and you narrow some of that margin, which makes it a bit easier, but that's not what the Fed wants. That goes against what the Fed wants, which is why we see some of this additional action. Now, speaking to wages again versus assets, this purchase only home price index for the United States, when you look at just where home prices are, kind of flatlining at the top, and hourly earnings, there's a huge disconnect in terms of these different flows. And is it easier to push wages up and then hope that you can bring it back under control, or try to bring down some of those asset prices and home prices? And that's the most likely thing. So even if you use a different metric, so a new metric, because why not? A new metric from White House Council of Economic Advisors adjusts for non-housing service workers in order to get a better read on relationship to core inflation ex housing. Year-on-year wage growth well off peak, elevated relative to history, but pace is easing. So no matter how you look at it, wages are coming down, and they're coming down faster than inflation is coming down. So even inflation hurt on the way up, and it's still hurting on the way down. And as we've been saying for the last several months, as we're saying again here, we don't see inflation. The rate of change coming down is going to slow, and there's a lot of that stickiness and stagflation we see. And then when you look at the non-farm unit labor costs, they went back up. But then the reason why is you still have a very low amount of participation rate. The number of retirees is still well above the normal trend from 2017 to 2019. We have 1.7 million excess retirees. So that shortage is creating this backdrop with the employment side, with the unit cost. And that's, again, an inflationary backdrop and that stagflationary piece. So wages continue to come down, but there's going to be some stickiness. And as you try to hire new people, it becomes another problem as well. Total consumer credit owned and securitized continued to outpace the previous trend and set a new record. Revolving credit owned and securitized, again, continuing to move closer to those levels. But then the revolving credit, consumer credit owned and securitized against disposable personal income. It's still affordable, but again, we always issue caution on both sides, because you could say, oh, well, you're focusing too much on credit, which is true. Not everybody is running that level. And some of that credit is probably also weighted heavier towards the richer quartile and quintile, which means that the pain is much less. But we're talking and trying to hone in on the ones that get impacted the most. So it's hard to kind of put a box around just the entities. But this is something where we think disposable personal income is still overstated, given the amount of people living paycheck to paycheck, given the amount of pain that has been taken on. So then the revolving consumer credit continues to shift up, and then the real revolving consumer credit still is below pre-pandemic when you consider it for inflation. But again, the inflation side, it's each quintile, decile, they spend differently. And as we showed before, each one is still seeing a double-digit pain. So it's hard to say that this is going to be universal, as we've highlighted some of those key points. Merchant wholesales growth continued to decelerate, unchanged month on month in December, but 6-month annualized continued to slow. So again, merchant wholesaler sales slowing. We see that drifting down based on the ordering side, the intermodal side, the inventory. So again, we still see some of that downside. Inventory growth continues to normalize. Speaking back to sales, wholesale inventories increased by only 0.1% month on month in December, which brought the 6-month annualized down to about 8.6%. But again, much more normal, which is why we see some of these underlying slowdowns. Non-farm payrolls expected to be at 188, came in at 517. And the household survey is catching up to where the payroll side is. And that's going to be an interesting point, which is why when we look at the monthly change in non-farm payrolls, and then the household survey, there's still a divide. But as we were saying, they were going to merge somewhere in the middle. And we think that there's going to be an adjustment where it's still going to show growth. It's still going to show something positive, and that's going to keep the Fed more active in raising rates. Apartments through end of 2022, apartment rents were still growing at a slower pace. Effective rent growth increased by 2% in the fourth quarter, up from 1.9% in the prior quarter, but well off peak. And again, this is an inflationary push where even though the rate of change is slowing, it's still increasing. It's still going up. And that's, again, going to be some of that impetus for that stagflation. And it's important to look at the non-cyclical rate of unemployment, which is expected to be at about 4.5%. So essentially, we're saying that natural unemployment should be at 4.5%. Instead, we're at 3.7%, which means that we are below full employment, which is it means that there's enough room, there's enough space for the Fed to increase rates and try to drive some of these slowdowns and cool off the economy. But the U.S. labor force participation rate still continues to be exceedingly low versus historics, which again, it went up, but minor. We have more retirees, and this is keeping some of this job side sticky and problematic when you look at wages and you look at underlying cost. But again, cycling back to this chart because it's so important, hourly earnings are still coming down. So even though the wages, the cost is there, you're still seeing it's still drifting lower. It's just not coming down fast enough because you're having prices stay higher, which is, again, going to keep the Fed active in rate rising. Taking longer for prices component, when you look at the breakdown between business prices, manufacturing, and service, again, stagflationary. Look at the rate of change of the service side. It's coming down, but it's slowing. It's flattening out. And it's still at 67.8. Going back to 2000, we're still at a very elevated level for for services. Manufacturing has come down. It's in a deflationary standpoint, but remember, 70% of the GDP is service-based. So 70% of the economy is still experiencing an inflationary backdrop that is expanding, and only 30% is seeing a deflationary side. And again, they're just using round numbers. There's probably some variation with that, obviously. But this is going to be, again, the impetus for where are we seeing the data sets that's pointing to the Fed not doing and continuing to raise rates. And that's when you start looking at service PMI. January ISM service PMI jumped to 55.2, expectations of 50.5. Employment rose slightly back to slight expansion. Prior and new orders soared to 60.4 versus 45.2. So it's a positive number. We still see some downward pressure, but as we've been saying, services is going to do better, especially when you factor in that some of these drivers that are creating this positive movement are inflationary. And that, again, leads back to what we've been talking about with a lot of these inflationary pressures. ISM prices paid. Again, this is going back through time. You see that inflationary pressure and why we see those problems on those different levels. So then when we look at ISM Manufacturing, January ISM Manufacturing fell to 47.4 versus the estimate of 48. New orders fell to 42.5 versus 45.2 previously. Employment fell to 50.6. So prices paid ticked higher, went from 39.4 to 44.5. So you still saw some increase in manufacturing price. Even though it's still contracting, it's going back up. And again, everything's showing you manufacturing is slowing. We don't see that changing. We're going to talk about some of the leading indicators in the next segment. But again, this is going to be some of those problems, some of those pieces that are going to continue to get a bit worse. And this just breaks it into its components. But the new orders is the biggest problem because new orders are dropping. And think about where the U.S. gets its raw materials, its intermediary goods abroad. So again, as new orders come down, that means that you don't have to order new stuff. So your imports are going to come down. You're going to be giving less dollars into the market, which again, we saw play out in the most recent data that we've been talking about, looking at shipping and rail and trucking. And then when you look at the gap between ISM New Orders component, which has plunged, versus the S&P, again, you get this divide where the market and the new data came out on the bull bear side, where retail has gone bullish again. And that's, you've seen these swings, and there's a lot of this assumption that things are getting better. And then the spread between ISM Manufacturing New Orders and employment is the lowest and most negative since June 1980. And again, all of this stuff points back to the early 80s, which was not a good period for the economy, and why we see a lot of these underlying pressures. So that's what we have for you here. In the next segment, we're going to go deeper into other components of leading indicators in the U.S. and where we see the economy playing out over the next few months.